you have it started again?
Yeah.
Thank you, sir. Any questions about that? So they give you an illustration of that on the bottom of 289. I think you can read. I'm not going to worry about that. Okay? So far, are we good? Everybody good? Okay, I'm not through with our first point, which is computing the cost of the inventory purchase, because we've talked about purchases. The invoice, $35,000. We've talked about purchase discounts. The most common, by the way, is 210 net 30. That's the most common generic, homogeneous. My husband is 110 net 11. He wants his money up front. They manufacture and sell concrete blocks and brick. Once you put it into a wall, it's kind of hard to reclaim it, repossess. Hello. So he does 110 net 11. That gives everybody a real incentive. Of course, if you're not going to pay it by day 10, many of them wait until day 75 or something, and then he just doesn't sell them to it very often, right? Makes them do cash on delivery or something, COD or cash before I deliver it, whatever. But the most common in just overall general industry is 210 net 30, which would give you 20 days that you get 2%. How many 20 days are there in a year? Let's round our year to 360. So there's 20 days, 20-day periods, times a 2%, 36% annual interest. That's a hefty percent, isn't it? Where can you get 36% legally? Risk-free. Very often. No. Right? No. So you take your discounts. Everybody got that? We're going to take our discounts. We are going to take our discounts. Yes, ma'am, we are. I kicked that dead horse enough. Okay, so let me see. Who can I pick on today? Jake, I'll pick on you. Okay. Are you pickable? Pick-on-able?
I got a nappy, but I mean,
You got strong shoulders and I can keep it on?
Sure.
Okay. So Jake manufactures something. Tell me something that you could put a whole bunch of them into a semi-truck.
Skateboards.
Jake manufactures skateboards. Okay, and give me a state that is west of the Mississippi. That's on the left side.
California.
California. Well, you don't want him to be embarrassed if he doesn't know his west. Yeah, okay. Yeah, the left. Yeah, left side. Left, right. Okay. So Jake manufactures skateboards in California. And Katie, can I pick on you too? She's our buyer. Okay, and she buys, and I need a state on the right side. I need a state on the east side of the Mississippi.
Like East Coast? Tennessee.
In Tennessee. So Katie is in Tennessee, and she buys skateboards from Jake that need to go all the way from California to Tennessee. So far, so good? Okay, and so then we need a burly truck driver. So, Kara, will you be our burly truck driver? Okay, so Kara's our truck driver, right? And she has her own semi-truck. Good girl. And so so Jake contracts with Kara to take these skateboards from California to Tennessee. Are we good so far? Okay. So the place of selling is where? The seller's place is California. And so that is called shipping point. That's where we ship it from, his back dock. Okay? Where is destination? Tennessee. Okay. So what we have on most invoices, and you see it, maybe you don't see it on here. I don't remember whether they've got a picture of FOB or not. It's FOB. 290. Yeah, they don't have an invoice that it's got, but a lot of times your invoice will have a box that will be FOB, will be the heading of it, and it'll either say DEST for destination or SB for shipping point. what that tells us is where it changes title. Because once it goes into Kara's truck, okay, if it's FOB destination, it doesn't change title until it gets to Tennessee. And so while it's in the truck, it belongs to Jake. And really, legally, it's his responsibility to pay Kara. Does that make sense?
Can you say that again?
FOB destination means it changes title at the destination. The destination is Tennessee. So somebody's got to own it. It's not Kara. She's just a subcontractor. So it belongs to the seller until it gets to the destination. Make sense? So it's his responsibility to pay her, and it's his ownership. So even if we took inventory for Jake, we would count all the inventory that's in the warehouse, but we'd also have to count the inventory in Kara's truck. If we're doing a balance sheet and he leaves like December 30th, and then he stops at home, or she stops at home, somewhere in Colorado, okay, for the holiday, and then it doesn't get there until January 2nd. Then on December 31st, Jake owned it. And so we'd have to add it into his inventory. Does that make sense? We'd have to think about all the FOB destination for Jake that weren't there yet and add those to his inventory as we take our inventory. Cool. Because it belongs to somebody, and these FOB terms decide who it belongs to. If, however, it was FOB shipping point, then once Kara backed out and got off that property, it belongs to Katie. Make sense? So even if she doesn't get it till January the 2nd, if she took inventory on December 31st, it had left December 30th, she'd have to add the FOB shipping point that was in transit on December 31st. And she's responsibility to pay Kara. Okay? Now, in real life, Kara's not an idiot. She's a very smart young lady and a good businesswoman. So she is not going to leave California with her truck and expect to get money from you, Katie. No, she's going to make Jake front the money. So Jake will add to what Katie owes the FOB charges. And there's no discount on it because Kara's not going to give you a discount. So you would add, for this price, you would add FOB shipping point in process. Because he's going to credit cash, pay Kara, and debit accounts receivable. And she's going to have to credit accounts payable and debit inventory for Kara's cost. And not only that, but heaven forbid, heaven forbid, she's going over the Rockies, okay? Are you with me? And some idiot runs into her truck, and there are skateboards all over the road. Do you see this? What a mess. Okay. Whose loss is it? Well, Jake. Hopefully you made sure that she has her insurance current. And she would file her insurance, right? To pay for the loss. But if you were not diligent and her insurance has expired, if it's FOB destination, it's your loss. You have to claim it on insurance. If it's FOB shipping, Katie's loss. So it determines who puts it in their inventory when it's in transit. It determines who pays Kara, and it determines who is responsible if there's a loss. That's a pretty important concept.
Who chooses which one it is?
They arm wrestle. It's negotiable. In most industries, it's one way or the other. And so different industries, different ways. But it's always negotiable. All terms with a contract are negotiable. So even if it's normally FOB shipping point, Katie could negotiate it to be FOB destination. And that saves her some money, doesn't it? She doesn't have to pay Kara's costs. Is that cool? Okay. So, let's do a little bit of computing. Well, before we do, page 291 gives you some journal entries. Freight in is the buyer. Freight out is the seller. But freight in is inventory. Freight out is not. It's an operating expense. I'm going to write that on the board so you can memorize it. You see, when we try to figure out the cost of an asset, it is all costs necessary to get it ready for its intended use. All costs necessary to get it ready for its intended use. Well, for Katie, that would mean if she has to, it would mean the invoice amount, minus any discount, minus any returns and allowances, but plus any shipping that she had to pay, if it was FOB shipping point. And that would be called freight in. This is for Katie. You with me? Because she can't sell those skateboards until she gets them. So that is a cost getting it ready to be sold. Kayla?
I got it.
Okay? So for her, shipping, if it's FOB shipping point, for her, Kara's price is part of inventory. So she is actually going to debit inventory and credit cash and pay Kara. Okay? It is part. Or if Jake has fronted it and he's going to charge her that extra, it's still an inventory cost for her. If we add it to that $27,000 number and it's another $1,000, then all $28,000 is inventory, debit inventory. Okay? Are we following? All right. But if it's FOB destination and Jake has to pay it, then he's already got it ready for its intended use. To him, the intended use is to sell it, right? It's ready. It is not an inventoriable cost. It's already sold. For him, it's a selling expense. It's an operating expense. And we are going to have on our income statement, and I will show it to you now, even though we're not ready to really look at it completely right now. But would you look, and don't get scared, at page 312, it's a little bit bigger than what you did in chapters 1 through 4. Don't be intimidated. I know. Who knew? This thing is huge. Okay? So, but notice that instead of service revenue at the top, we have sales revenue. And then we've got a couple of contra accounts, less. And then we have cost of goods sold. That's our new expense. I gave you that last time. Our new expense, right? And then we have operating expenses in the middle of the page. You see that? And there are two categories, selling and administrative. And one of those selling is delivery expense or freight out. So if Jake has to pay it, that's where Kara's goes. That's where the cost goes to Jake. But if Katie has to pay it, it goes in cost of goods sold. Because it went into inventory, and when they sell it, it comes off. You may want to, even though we don't normally go back and look at this, and you're here today, you may want to go back in this part 2 of chapter 5. You may want to watch this again, okay? Because this is kind of a tricky concept, isn't it? So, just FYI. Again, you'll find it on the portal when I post it. You'll find it, and it probably will be done the next day or two. You will find it between in the videos section or in the resources, one of the two. If there's a video section, it'll be there. If not, it's either in bookmarks or resources, but you'll find it one of those 3 places. I'm not sure. And you can ask me in class, and I'll tell you where I put it. Would you hit that again?